Hey guys, let's take a look at 7 of the most common options or trading strategies and the respective return for those strategies over the last 5 years. Maybe it can help us in the next 5 years. The criteria I used to conduct this test is listed on your screen now. All trades were near 30 days to expiration. It was $1 wide and only one contract lots. All trades were on SPY. All trades were bullish with the exception of iron condors and covered calls. Most options were at the money with the exception of iron condors and covered calls. Each of those were open with a short at 30 deltas to keep it simple and consistent. But before we get into it, I want to let you know I initially threw this spreadsheet away and abandoned this video completely. I thought maybe it was stupid or just a waste of my time, but as if God had willed it so, the importance of the information hit me suddenly and I rushed to find it on my computer. Stick with me until the end of this video and I'll share with you why I think this video and this spreadsheet are so important. Quickly, so everyone knows what they're seeing on the screen, you'll notice the table with the last 5 years in the columns and the months in the rows. I entered one position each month and held it to expiration for a total of 12 trades per year for every strategy in this video. Below that in the gray shaded row are the yearly totals, and out to the right of the table is the monthly totals across all 5 years. Below the table are some important performance metrics for each strategy. And to the right of the screen are some bar graphs showing the yearly or monthly P&L respectively. With that said, the first test I ran was the simple long call strategy. If we had traded nothing but long calls each month since 2018, we'd have pocketed $8,957 off of $32,904 of risk. That works out to about 27% return on risk. The win percent wasn't the greatest, we'll see from the 7 strategies in this video, but given the risk profile of long options, the strategy did quite well. Now, 27% over 5 years isn't exactly earth-shattering at just 5.4% per year, but it was profitable, and if we had scaled up our position sizes or conducted any form of management, the outcome could have been greatly improved. Some important takeaways from the long call strategy: April, July, August, and November were the best performing months. February and September were the absolute worst performing months, and it may be more profitable trading puts during those 2 months. Something to consider. Next up is the short put strategy. The first number that likely jumps out to you is the insane $2 million of risk. This number is an estimate based on being assigned shares from each and every trade. On any given trade, the risk was the strike price minus the premium times 100 shares. The total risk is an estimate because I didn't want to take time to individually calculate the risk for each trade over the 5-year period. A few things to note here: the strategy was profitable, but considerably less so than the long call strategy, but with far more risk. The largest win to the largest loss was in line with expectations given the upside cap, but it's still uncomfortable to see. The win percentage was great, but the profit didn't follow thanks to some big losses. Again, with any management plan, this could have likely been mitigated. May, July, and November were the best performing months across the 5-year period for this strategy. Moving on to debit spreads, every spread was a bull call spread here and only $1 in width. From a risk reward perspective, this strategy really caught my eye. However, with only $480 in profit over 5 years, it could definitely use a little extra juice. Because of that, we'll look at one possible enhancement to this strategy in just a minute. First, some conclusions regarding the debit spread strategy. It was a very low overall risk. There was a great win percentage. February, June, and September were the worst months overall to trade this strategy. April, July, and November were the best. 2022 was the only unprofitable year for this strategy, losing $279 in total. With that out of the way, let's circle back here really quick and look at one way this strategy could be improved upon. Moving down the screen, you'll see I've recreated the table above, only this time utilizing a management approach. Here were my criteria for this enhanced bull call spread strategy. I was going to open 3 lots of each $1 wide spread. I was going to create a stop loss for one spread at 20% of the risk capital. I was going to create a stop loss for a second spread, which was at 40% of risk capital. And then I was going to hold the third spread until expiration regardless. And then on the profit side, the profit target was going to be set for the first spread at 50%. And then the profit target for the second spread was going to be at 75%. And then I was going to hold the third and final spread until expiration. If these steps were conducted on each trade during the 5-year period, you can see the result would have been $1,833 in profit on just under $10,000 of risk. That's roughly a quadrupling of the profit potential for what I feel is an acceptable amount of risk. Of course, this and every strategy we discuss here could be managed in thousands of different ways to improve returns, but I thought given the lower P&L, you'd like to see at least one way the return could be improved. In any case, next up, we're going to see the credit spread strategy. I used the bull put spread for each trade, and the overall return was absolutely pitiful. I must admit this makes sense given that I'm almost never profitable on my own short put spreads. A couple of takeaways from the short put spread were in April, July, and November were the most profitable. February and September were the least profitable. Profit potential is just too low as a standalone strategy unless volatility is greatly elevated, but that isn't a guarantee of profit because volatility, as we know, usually increases as the stock falls. To give us a well-rounded test of strategies, I thought it was also important to consider a neutral strategy. For that, I used the Iron Condor. No month and no year were profitable trading this strategy. The win percentage was atrocious, and honestly, without managing your Iron Condors, I would just steer clear of this strategy altogether. Some takeaways from this test were December is bearish across every strategy we've looked at. January, May, June, September, and November were the least volatile. Now we'll move into the more capital intensive strategies. First up is simply buying and holding the shares. You'll notice the risk is the same as the short put strategy, and that's because I didn't want to recalculate every trade across the 5 years. You'll also notice it's the most profitable strategy yet, but it does come with, of course, the higher risk of loss. That said, at no point was I holding 2 million in shares. That's just the combined total of every trade. Had I simply used the median risk or something similar, the percentage return would have been far better. As expected, the biggest loss occurred during COVID. Not as expected, though, was the greatest win occurred just a month later. 2022 was the worst performing year as we would have guessed given the approximate 20% decline of the S&P that year. Some important notes from the buy and hold strategy. July, October, and November were the best months to hold shares outright. February, March, and September were the worst months to hold. The test negates compounded returns, which could be impactful if we considered the dividends. And the final strategy I tested was the covered call position. While the strategy was overall profitable, simply buying and holding the shares was more profitable. Again, however, this negates compounding the options premiums or any dividend payments, which could have dramatically changed the total return. Some key takeaways from the covered call were about what you may expect. The upside cap limited the rallies but left the downside unchecked. July and November were the best performing months, and March and September were the worst performing. With every strategy considered, let's take a look at a comparison of each strategy to uncover what would have been the absolute best strategy to trade each month or each year. From the top left, I simply went through each strategy in the chart to the bottom left and determined whether each month was bullish, bearish, neutral, very bullish, or very bearish. But let's pause here briefly so I can share with you what I promised when this video began. While the COVID crash has certainly impacted these results, I don't want to ignore the fact that over the past 5 years, February and March have been the two of the poorest performing months for the market. As we enter the beginning of February, if the data holds any value, now may be a good time to hedge some risk or employ option strategies that benefit from potentially more downward pressure. With that, please remember that no amount of data is a crystal ball, and the current bullish trend could very well continue. And just so you know, I'll be using the next 2 months to build out my cash position, buy shares at a lower price, and keep my options trades focused more on the bearish side. That isn't to say that I won't take a bullish trade, it's just that I'll need to be fully convinced before I'm willing to do so. Getting back to the spreadsheet, you can run through each month to see if you agree with my assessment of bullishness to bearishness. Just to the right of that, you can see I created 2 lists of what I call the safest trades and the best trades. Basically, it's just lists of the top 2 performing trades for that month. For example, look across January in the bottom right table, buy and hold was the best performer and the debit spread was the second best performer. I then took that data and calculated a P&L in the tables to the right to show a hypothetical return if we had traded the absolute best 2 strategies over the past 5 years. The best strategy would have returned us $25,718, while the safest strategy or the second best strategy would have yielded us $13,117. But that brings us to the end of this video. I hope you were able to uncover something of value, but please do let me know in the comments if I missed something. I tried to be as thorough as possible so that we might have some idea what direction the market is likely to head next. In my opinion, that answer is clear, but if you look back over every strategy, you will again see that COVID has greatly impacted that assumption. Finally, please consider liking and subscribing to the channel. It really helps me. And until the next video, take care.